let's do it. So this is me thinking I'm very funny, and we'll get started. All right. First thing to note is that you may know that REBA stands for Real Estate and Business Brokers Act. And every single one of you has started your career concentrating on the first two words of that, real estate. And you've completely neglected the fact that maybe you haven't, but most of us neglect the fact that there's an entirely different component to REBA called the Business Brokers Act. You are entitled to sell businesses. You're entitled to do that, which is different than a condo, and it's different than, a commercial land or anything else. It's a business. Now, having said that, as I've written here, when you get your license, you're entitled to theoretically drive all the way to California. It doesn't mean you should, right? The fact that you have a license to do this doesn't mean you should go ahead and do this. I would suggest to you that, especially if you are trying to sell your first business, you do so with a driver in the car that knows how to get to California and that perhaps can give you some tips along the way. Quite important. But having said that, you do have the right to sell businesses, and more importantly, from your perspective and from my perspective, you have the right to make money selling businesses. So how do we do that? That's what today's about. So, firstly, let me just address the elephant in the room, and the first thing that gives a lot of confusion to people when you're thinking about selling a business. And that is that most people understand that there are two different types of businesses in this world. There are businesses where you have a corporation that owns businesses. And then there's your mom and pop store, variety store, or whatever it is, whether it's incorporated or not. And the value of that business is usually in the shelves, the inventory, and the physical lease location, right? There's no benefit to the corporation in any way. What you care about is the structure and the ability to sell pop cans. Right? Those are two different businesses. One is shares, one is assets. Now, let me just, so the definition, again, assets include really a business's equipment, inventory, and goodwill. And shares of a business are what give shareholders the right to claim their stake in a corporation. So what's interesting is that if you sell the shares of a corporation, you are effectively transferring that business to a new owner. Or if you sell the assets of the corporation, you're effectively transferring a business to a new owner. As real estate agents, you are able to make commission on both types of sales. There's no reason why you cannot arrange for a deal for the sale of shares. But under no circumstances are you as agents going to paper that deal. You're not going to paper that deal because the sale of shares is hugely complex. When you are taking over a business for its shares, you're taking over all the liabilities of a corporation, any lawsuits from the corporation, and more importantly, any of the tax losses or tax gains or any of the accrued liabilities of the corporation. And you as a real estate agent are not set up to do that. You know who is set up to do that? Corporate lawyers in conjunction with tax accountants. So what you can do is if you have someone who's ready to sell shares, you can definitely form a commission agreement and then introduce them to the requisite professionals to ultimately do that out. But under no circumstances are you going to arrange for the sale of shares of a business ever, ever, ever. Okay? What you can do, however, is you can arrange for the sale of an asset purchase. And actually, that's the vast majority of times that you are going to be engaged as a business broker. Because the vast majority of people who are going to come up to you and ask you to help sell their business are laundromats, are variety stores, are coffee shops, etc., etc., etc. All the places where the corporation doesn't matter at all. What matters is the fact that you have your shelves, you serve your coffee, there's a customer base that knows that you exist and are ready to pay you $3 a day for these things. And that's generally what you see on MLS. That's generally what we're going to address today. So, just because, I like what I wrote here, just because we're a bunch of crazy agents who live on the edge by attending lectures by 43-year-old boring lawyers, let's talk about REBA for a second and let's talk specifically about the Code of Ethics. If you are going to sell a business, whether assets or shares, but particularly assets, because that's where you're going to delve into things, The Code of Ethics, Section 21, says something about that. It doesn't say it specifically. It doesn't say if you're going to sell a business. But what it says is a broker or salesperson who has a client in respect of the acquisition or disposition of a particular interest in real estate, so that happens to be a business like a variety store or anything else, shall take reasonable steps to determine the material facts relating to the acquisition or disposition and, at the earliest practical opportunity, shall disclose the material facts to the client. I'm going to put that in English for you. What is it that you care about when you buy a business? What do you care about? How much money they make. That's it. That's the material fact. How much money they make. That's what you care about. And the Code of Ethics states that you as an agent have an obligation to secure from the sellers, or if you are representing the sellers, to provide to the buyers financial statements. And so the first thing that we need to turn our attention to today is what the devil are financial statements. What do you need to supply? So let's go into what the financial statements are. I know some of you may know this, but let me just go into it briefly. And by the way, I'm kind of going quickly through a lot of this stuff because when you get your deal, you're going to remember that you heard some talk. You're going to look this up. You'll look this up. You'll give me a call. You'll say, hey, what the heck do I do? You'll figure this out. I really want to get to the meat, which to my mind is how do you value a business, which has nothing to do with law. That has to do with business, but how you value a business is really critical. But let's keep on going through the soup and salad dish. So there are 4 financial statements to a business. Okay, the balance sheet. And what that is the financial position or condition of the assets and liabilities of the company. Bart, you know this better than most, I'm assuming. The income statement, which is the profit and loss. And what that is it's a list of the company's assets, current liabilities, income, expenses, and the like. Statement of retained earnings and statement of cash flows. The be-all and end-all is that there are, every year for a corporation, a document that is produced. It's produced by a chartered accountant. It's produced by a CPA. It can be produced by anyone, really. But what they are is they detail the company's financial position, how much money it has in its bank account, and what its projected cash flows are going to be going forward. How do they do that? Well, for most people, at the end of the year, they go up to each and every one of you, if you owned a company, and the accountant said, all right, give me your expenses, give me your revenues, and you give them all the stuff, and they produce these nice little statements, and they put on it a slap sticker that says, notice to reader. And what notice to reader means is that I am simply accepting what Bart is providing to me. I'm not checking it. I'm not verifying it. He's given me a bunch of stuff. I've taken that bunch of stuff and I've put it in the associated headings and I've charged Bart $1,500 for the privilege. Thank you very much. This is the state of affairs of the company as Bart states. That is different than the audited financials. And the audited financials are when Bart comes up to me and says, here's my material, and then you put them into the same lists. But after you put them into the same lists, you then go back to Bart and say, okay, Bart, surprise inspection, though it's not really a surprise, you go over at that time. And you say, I want you to pull the following things. You gave me line 1,000, line 2,035, line 6,000, and give it all to me. And you take a statistically valid amount of material, and you verify the veracity of the data that came to you in the first place, such that you can put a line on that says, I am a registered chartered public accountant, and I have done an audit with Bart, and I have verified the authenticity of these numbers, which you can rely on pursuant to GAAP principles. And so, your statements that you are going to provide to someone are going to be one of 2 flavors, on notice to reader and audited financials. Let me tell you the facts of life. When you sell a business, you almost never will see audited financial statements. There is no person on this planet who is running a variety store or a donut shop who voluntarily decides that instead of paying the $1,250, it should be $1,500, but they've negotiated it down for a notice to reader because it's their brother that's doing it, that they have decided that they're going to pay $5,000 for this audited privilege. They just won't. And the banks won't require it of them until they hit certain revenue numbers. So if someone is in a state where they are selling their business, donut shop, variety store, hairdressing, whatever, they are very, very, very unlikely to provide you with audited financials. They will provide you with unaudited financials. They'll provide you with notice to reader. And as, yeah.
Just wondering, what's the amount of revenue they need to be producing for the bank to require the audit?
Generally, if a bank is into you for more than $500,000 in debt, they will require for personal services. If it is for hard product, they will insist on debt loads of $750 or more, by the major banks, necessitate audited. But also, if there are existing lines of credit in excess of $250,000, generally they will also insist on audited, unless you're a professional service corporation. This is all very detailed, but basically, if you are running a business with less than $500,000, usually in credit or debts or anything else, generally they do not insist on it.
So it's based on your debt and credit load, not your...
Right, because it's the banks that want to be satisfied. They're saying, hey, we have exposure to you, and excuse my Yiddish, fuck your notice to readers. I want to know what your real situation is. Now, here's the problem, guys, and let's get into the be-all and end-all of your problems as selling a business. When you go up to your seller is going to tell you what about the income that comes in from the business. They were stupid enough to buy a Mr. Sub franchise, right, instead of Subway. They were just cheap as whatever, and they now ended up with this. What are they going to tell you about the revenue? Tons of, not only tons of cash, it's just doing great. Oh my God. You should see our notice to reader numbers, which they've manipulated specifically for this purpose. In fact, you'll see that there's going to be $100,000 in free cash flow. In fact, I've never seen a business that has under $100,000 in net operating income that is up for sale, ever, because you can't sell a revenue stream of $30,000 a year. No one cares about that. Thank you very much. I'll go ahead and get a job at McDee's and not take on any debts, and I'll make $30,000 a year. I need at least $100,000, and so magically, every single notice to reader that you will see has at least $100,000 in income. Or if they don't, you know what they'll say? You know what happens much more often than not? I don't have them. And you'll say, I don't understand. You've been around for 10 years. How do you not have them? They'll say, you don't understand. It's all cash, or I don't have them, or I don't report tax, or they'll do something. But either they won't supply you with them, or they'll provide you with a notice to reader, which frankly you can use when your toilet paper runs low. Right? Like that's what's going on. That's the reality that you are dealing with when you are selling a business. So if that's the case, what do you do if someone doesn't supply financials or supplies notice to readers? Because frankly, they're the same thing. Well, you do what our friend Reagan said. You trust, but you verify. And so, firstly, if someone doesn't have statements, you should know your obligations as an agent. You must get this statement of oath filled out. And the statement of oath says that I am not providing books of account, and it says I, the buyer, having received the statement under oath and the person disposing of the business, waive compliance to receive financial remuneration. So if they're able to provide a notice to reader, you don't need to do that. You still need to do a sale of a business. They just don't need to sign the waiver. If they are not providing notice to reader, P.S. they never provide notice to reader, you must get this by REBA requirements. It's right on your web forms. The sale of a business. And what it does is it says, thank you very much. Here's how much the business is, or I'm not providing the books. And this is the person saying, I accept that you're not providing books. Now, why would someone who's purchasing a business accept that you are not providing books? Well, because you're not going to ever provide a business for a Mr. Sub or a Tim Hortons or whatever it is. Well, Tim Hortons you will, but Tim Hortons are never for sale. A Mr. Sub or a Mr. whatever franchise, hairdressing franchise, you're never, ever, ever going to provide a firm deal, a clean deal. Instead, you're going to provide something with this Schedule A clause in there. And I want you to all remember this, because if any of you bring an offer without the Schedule A and unaudited or audited financials, I will personally come and kill you. And it says, this offer is conditional upon the buyer in its sole and absolute discretion, being satisfied as to the income being generated by the business. The seller agrees to permit the buyer with unrestricted access to the business for a period of 3 months following acceptance of this offer, during which she or he shall be allowed to monitor all business activity and review all daily revenue accrued to the business. In other words, thank you very much. I'm going to trust but verify. I will sit my rear down by your cash register, and you're telling me you're making $100,000 a year? Show me. I want to see that cash register. I want to see you push that button. I want to see these revenues come in. 3 months of my life, I'll spend it by your side, watching these revenues, so that when you show me that your revenues are X, I have 3 months worth of material to say, yeah, there's realistic facets behind those numbers. P.S. It's not going to prove real. You are going to find that the business makes $50,000 to $70,000 every time. Every time. Because if someone is making $100,000 or more on the business, they either sell privately or they transfer it to their kids and it's an okay business and yada, yada, yada. And if someone is making $0, generally the fraud doesn't get sustained for very long at all. And most people aren't in that business. They just shut down or go bankrupt or whatever it is. But when someone has a menial amount of income, 50 or 60, they try to exit. That's where their sweet spot is. That's where the sweet spot is of the people who are going to call you up and say, hey, I want to sell a business. Not always, but most times. And so you're going to get documents that say, yeah, we make 100, and they're going to sit their rears down and they're going to find out that it's 50. Every time. But upon discovering it's 50, you're able to negotiate reduction in the prices, as the buyers want to do, because they're not going to waive their rights until such time as the 50 has been proven out. Make sense? Okay. So, point of this slide is not only to introduce this clause, it's also to introduce the statement under oath. If any of you sell a business, you must get the statement under oath, whether or not you have financials or not. And the waiver has to be signed if financials are not being provided. Does that make sense? Okay. This is much more important. This is actually the slide that you came for. Because it's all well and good that lawyers believe themselves to be self-important and that we like to pat ourselves on the back because we went through law school. But frankly, anytime you're listening to a lawyer for advice as to how it is you consummate a deal, you are losing money. Because lawyers are only there to slow down your deals. They aren't there to help you make them. And so it's all well and good that I can tell you the legalities and the lines you have to cross. But I'm going to switch from lawyer for a second to real estate agent or real estate broker, and I'm going to tell you how it is you actually value the businesses, because this is the essence of what you do. You need to negotiate a purchase price. And before I talk about the business, I'm going to talk about all businesses generally. I don't know if you've ever really stepped back and thought about what we do, but whether it's real estate, whether it's mining, whether it's a business of any sort, what we do collectively is we say, hey, what is the ongoing annual revenue from X? You want to open up a mine? How much money can I make year over year from that mine? You want to open up a hair salon? How much money can I make year over year from that hair salon? And what we do as real estate agents, particularly with real estate, you want to buy a condo? How much rental income can we get year over year from the condo? And what we do as real estate agents is we say, all right, we think we can get X dollars for future years, and that's worth the following amount in today's money. That's what you're doing. And selling a business is no different. Someone is coming up to you and saying, hey, you know those rental incomes that I can get? Well, that's worth the following amount in present day value. Someone who has a hairdressing salon says, hey, you know this $100,000 that I can get every single year by my work? Well, that's got to be worth something in present day value, because I can sell that so that you can get $100,000 every single day. That's what it is. And valuing stuff in present value has two fundamental components if you think about it. I just want to talk high level because this is what you should be internalizing as agents all the time. There is the value of the income stream. So I make $60,000 per year from my business. And that could be as true for owning a passive property like a condo as it could be for a hairstylist, right? I make $60,000 net operating after my expenses. And there's also the calculation of how long that $60,000 will continue on into the future. So as an example, if I'm buying a condo for $60,000, and if I'm buying a hair salon for $60,000, and the condo's ownership will vest in me forever, and the hairstylist salon's lease is for another 2 years, the fact that you are making $60,000 per year from both enterprises is not equivalent in today's value, because we understand that in 2 years, the $60,000 from the hair salon is going to end, but the condo $60,000 will continue in perpetuity. Make sense? And therefore, even though it's $60,000 that you're making from both venues, one $60,000 is far more valuable than the other $60,000. Right? And as a result, you're going to pay more for the $60,000. In fact, there are financial math calculations that go into this very fact. Right? If you think about it, what real estate is it is a perpetuity. Perpetual. Right? And there's ways of valuing that on a basis of a net operating income. Whereas the income from a hairdresser is limited in time. It's an annuity or net present value. And you can do these calculations. We won't talk about how to do them. Just know that we do them. Another way of thinking about it, even if there is longevity to your asset, there isn't necessarily longevity to the income stream. So let's just take two items that you guys are familiar with. If you own an apartment complex with $60,000 in income, and you own a hotel with $60,000 in income, you should be willing to pay more for the $60,000 that stems from a apartment complex. Why? Where it's more stable. Because when things go to shit in the market, hotels are the first thing that corporations cut and the revenues fall. But when things go to shit in the market, and you own an apartment complex, absolutely no one leaves apartments. In fact, more people clamor to get in because they can't afford homes. So there's almost stability in bad times. And as a result, this $60,000 is worth a lot more than this $60,000. What I'm getting at is this. When you are selling a business, you don't only, and the way you value the business is not only to figure out what the income stream is. Remember, sit your bum down, watch the cash register, or look for audited financials, but also to determine how volatile the income stream is and whether or not it's coming to an end in short order through leases. And once you have all of those factors in your head, you can then ascribe a value to the ongoing income stream coming in. Does that make sense? You'll note, I haven't talked to you how you do it. I haven't talked to you about the math or the discount rates or anything else. I'm just talking to you about the generalized concept of what someone who is selling a property would ordinarily have to think of. Does that make sense? Does everyone get what I'm saying there? Yeah.
I'm just curious, if you have a potential client that approached us and said, hey, I want to buy this business, and you say, sit your bum down and figure out, watch the cash, blah, blah, blah. Is that what we're going to translate to them? Or we're going to say, okay, what you need to do is if you want to buy this business and we don't have the proper financials intact, we need you to go there for 3 months. Is that reasonable?
Well, 3 months would be...
Them at that point in time, who's getting the revenues of the business. I feel like there's so many underlying questions to that one statement.
No, there isn't. The first thing you're going to do as a real estate agent is find out how long the cash flow is to maintain itself. How long is the lease? Because it's going to be in a lease premise. How much longer can we rely on this income stream? Because you have to relay that to the person, right? Okay, once you figure that out, say, are there any other extraneous things I need to know about? Are there any, and we'll talk about what those extraneous things are in a second. I have that as part of this. But once you've done that, then you need to say, okay, we understand that you have another 5 years of revenue streams of $100,000. We understand that you are effectively going to pay for these next 5 years. We understand that you have a lease that's guaranteed for those 5 years. The sitting your bum down is just verifying now that $100,000. And once you've done that, then the negotiation can take place, because then you're just talking about one thing and one thing only. You know that the 100 is accurate, or 60 or whatever it is after you sit your bum down. You know that that's accurate. You've worked it out. You know that there's longevity of purpose. You've worked that out. The only question you then have to address is, what is the volatile risk that this will terminate in that time span that we've given you? And there's not a high likelihood of that if you have a lease. And as a result, what is the discount rate? What are we dividing it by? What are equivalent businesses selling for, if you will? What's the revenue multiplier that we apply based on this being a hair salon in this area? And there's ways of figuring that out as well. That's all you need to do. There's not much more to the negotiation. Sorry, go on.
But if a buyer approached you, you would tell them you need to sit down with this.
100%. 100%.
For 3 months?
Well, 3 months is usually what I would suggest as a minimum. See, part of the problem you're going to have, I'll tell you just from experience, is that when you sit down for 3 months and it's lower and the negotiation begins, they're going to immediately spout off about how always February, March, and April are the lowest months of the year. Of course, if only you were here for June, July, August. So one of the things you're going to want to do is you're going to want to ask them, the business, before you sit your bum down, what are your highest months? What are your lowest months? Like, set the expectation so you're getting rid of these types of questions later on. And then say to them, listen, say to your buyer, I've been informed that these are average months. Sitting your bum down for 3 months will give you this assurity. And you can rely on these 3 months because they've already told us in advance that this is there. And that is really the best assurance you can give them. And that's usually what happens. I've seen 6 months. I've seen 3 months. I've even seen 1 month. I advise not to do the 1 month. But usually 3 months is a sufficient amount of time, provided it is not a highly seasonal business. There's no point in sitting your rear down on a fishing business for 3 months starting in December. Right? You have to make sure that seasonality is accounted for. Yeah? Okay. So does everyone understand this? Because this here is not law. This here is the essence of what you do. This is what's going on. A seasoned business agent needs to understand the income stream, the volatility, and the likely, I'm sorry, I forgot to turn this off. There you go. All right. Aha, isn't that cool? Look how technological I am. No one applauds. All right, fine. Screw y'all. All right. So here we go. That's how this works. Now let's talk about, so you've negotiated the price. We've talked about how you negotiate the price. And now you get to the easy part, which is filling out the agreement. And the agreement is slightly different than the agreement that you know. The agreement looks like this. It's an agreement of purchase and sale for a business in a leased premise, Form 502. You don't know if you've seen this before, but this is what it is. And I'm going to just point out a couple of things that make this slightly different than the business you are used to. Firstly, there's a non-competition. The last thing you want is the person who you're buying the variety store to do is to move, or the hair salon, to move next door and open up a hair salon, right? So there's a non-competition clause. It's fairly obvious. You can figure it out. The sellers, basically they're saying that there's no litigation. They're saying that there is a lease. They're going to attest to the duration of the lease. They're going to say there is a good and valid lease for where I pay the following amount and it ends at this time. Why do you care about that so much that it's part of the agreement? Because that dictates how long you're getting your income stream, which is the only thing you're buying on a business in the first place, right? So they put that into the agreement. And then they further covenant to comply with Section 6 of the Retail Sales Act. I could go into that. It's incredibly boring, but basically they bring their debts to the government up to speed to the day of closing. And what I really want to call your attention to is line 12, which is inventory. You'll note in the purchase price, you'll note that instead of just a purchase price, it says a purchase price of X dollars, which total purchase price includes the amount of blank in inventory of the business. So if you're buying a variety store and you've agreed to pay them $60,000 for the right to buy over the assets of this variety store, there is going to be a whole bunch of chocolate bars and a whole bunch of candies and a whole bunch of other things that are sitting there in the variety store on the day of close. You are taking that on as well. And as a result, what you're going to do is you're going to say, my purchase price is $70,000 because you're trying to pay them $60,000, of which the purchase price includes $10,000 in respective inventory at the business. Now, what if that's wrong? You are trying to account for this. Well, there is a provision in the agreement, and there are people who come in, inventory, that says prior to completion, the buyer is allowed to allow for a counter who comes in and literally counts up all the Tylenols, literally counts up all of the candies, and adjusts that $10,000 figure upwards or downwards depending on how much is inventory there at the end of the day. Make sense? I used to have this client, most brilliant client I've ever had. She's actually a friend now. And she found out, this is just an interesting aside, but so brilliant. Sometimes you just hear these things and you're like, she's a pharmacist. I can say this because she's no longer doing this. I was her lawyer. She's a pharmacist, and she read through the Shopper Drug Mart annual financials. And there was I remember it was note 37 of the financials. And it talked about, for some reason, I don't know why they put this in, but Shoppers put in what their strategy was for opening up new locations. Note 37. And they said, we will open up anywhere where there is no Shoppers Drug Mart in 50 kilometers and where there is a pharmacist who has more than 15,000 scripts. Scripts are how you measure a pharmacy, like the amount of prescriptions. And so she would go, she's like, okay. So she literally bought a trailer, like just literally from a trailer park for like $2,000. And it had like one of those things that opened up. This is completely not relevant, but it's just so brilliant. And it had one of those things that opened up. And she would go. I remember she did Bancroft, Ontario was my last one that we did with her before Shoppers finally said no. She opened up her fifth one in Bancroft, Ontario. She would literally find a parking lot, not even pay any rent because there was just Bancroft, Ontario, who no one even owns anything, and open up and just start selling scripts. And because she was a competent pharmacist, she would get like 15,000 scripts in like 4 months. And Shoppers, every time, would buy her out for $4 million. Like, it was astounding. She just kept on doing this over and over and over again. Anyways, why am I going into this? Well, one, because I'm jealous as hell. Two, because every time I would deal with the lawyer at Shoppers, his name was Michael, and Michael would call me up and he's like, all right, we're getting our inventory people, because they would have $4 million for the sale, plus or minus the inventory, which involved drugs. And so we would have Michael Gomes' inventory people come on in on the day of close, and they would count up all of the little pills, literally all of the pills. It would take all night. Well, it wouldn't take all night because it was a trailer. It would take like 3 seconds. But you know, like they would sit there, they would count up, they would adjust the purchase price, and my client would walk away happier than anything, and I would be very jealous. But anyways, that's how you deal with it, right? You ascribe a cost to inventory as part of the agreement, and the inventory is adjudicated at the end of the night, up or down, done, and so you get your purchase price. Other than that, it largely looks the same, and we've talked about schedule